Good afternoon, class. I'm going to highlight some important concepts in Chapter 20. So Chapter 20 is accounting for pensions and post-retirement benefits, fundamentals of pension plan accounting, and using a pension worksheet. Learning objectives. The first one is understand the fundamentals of pension plan accounting. Here's the illustration of pension plan accounting, an arrangement whereby an employer provides benefits, payments to retired employees for services they provided in the working years. And here you have an illustration that highlights the funds moving from the employer to the bank and from the bank to the benefits for the retired employees. Pension plans can be contributory. Employees voluntarily make payments to increase their benefits. Non-contributory, employer bears the entire cost. Qualified pension plans offer tax benefits. Pension funds should be a separate legal and accounting entity separate from the business. Here's an illustration of some companies: General Motors, Hewlett Packard, Deere Company, Merck, the Coca-Cola Company, and Molson Coors Brewing. The size of their pension fund in millions. So General Motors pension fund is like $79 billion. The two most common types of pension plans are defined contribution plans and defined benefit plans. A defined contribution plan, employer contribution determined by the plan, which is fixed. The risk is borne by employees, and the benefits are based on the plan value. Defined benefit plan, the benefit determined by the plan. Employer contribution varies. It's determined by actuaries, and the risk is borne by the employer. Actuaries make predictions. They're called actuary assumptions of mortality rates, employer turnover, interest, earning rates, early retirement, frequency, future salaries, and any other factors necessary to operate a pension plan. They do all the hard calculations. What do the numbers mean? Which plan is right for you? Defined contribution plans have become much more popular with employers than defined benefit plans, as indicated in the chart below. One reason is that they are cheaper. Defined contribution plans often cost no more than 3% of payroll, whereas defined benefit plans cost 5 to 6% of payroll. The total amount of pension plans held by pension plans is $22 billion, which is 127% of the gross domestic product. Types of 2 questions. What is the pension obligation that a company should report in its financial statements? And what is the pension expense for the period? So there's alternate approaches to measuring this. Employer's pension obligation is the deferred compensation obligation it has to its employees for their service under the terms of the pension plan. And you have a vested benefit obligation, accumulated benefit obligation, or a projected benefit obligation. The vested benefit obligation benefits for vested employees only at their current salaries. Accumulated benefit obligation benefits for non-vested employees at their current salaries. And projected benefit obligation benefits for vested and non-vested employees at future salaries. And this is the one that's chosen by FASB. Recognition of the net funded status of the pension plan. Companies must recognize on their balance sheet the full overfunded or underfunded status of the defined benefit pension plan. The overfunded or underfunded status is measured as a difference between the fair value of the plan assets and the projected benefit obligation. Here's an illustration on computing pension expense. These are the components of pension expense. You have service costs for the year, interest on liability, actual return on plan assets, gain or losses, and amortization of prior service costs. So looking at service costs, actuarial present value of benefits attributed by the pension benefit formula to employee service during the period, and the effect is an increase on the expense. Interest on the liability is also an increase. Interest for the period on a projected benefit obligation outstanding during the period. The interest rate is referred to as a settlement rate. The actual return on plan assets can be a benefit or a decrease, the increase in pension funds from interest, dividends, and realized and unrealized changes in the fair value of the plan assets. And the calculation here is actual return equals plan assets ending balance minus plan assets beginning balance minus contributions minus benefits paid. This is an important formula to remember, the equation. Number 4, amortization of prior service costs. Effect on expense is an increase. The plan amendments often include provisions to increase benefits for employee service provided in prior years. Company allocates the cost, prior service costs, of providing these retroactive benefits to pension expenses in the future, specifically to the remaining service years of the affected employees. Gains or losses. Volatility in pension expense can result from sudden and large change in the fair value of the plan assets and by changes in projected benefit obligation. Use of worksheet for employers' pension plan entries, learning objective 2. So here we have a worksheet. So the worksheet is pretty much made up of the items. You have items, annual pension expense, cash, your other comprehensive income section, which includes prior service costs, gains or losses, pension assets or liability. And then you have a memo record, which gives you the projected benefit obligation and the plan assets. And so the journal entries column determine the journal entries to be recorded in the formal general ledger. And the memo record column maintains balances for the unrecognized pension items. So here's, as an example, using a pension worksheet illustration on January 1st, 2017, Zarley Company provides the following information related to its pension plan for the year 2017. Plan assets for January 1st, 2017 are $100,000. Projected benefit obligations on January 1st, 2017 are $100,000. Annual service costs $9,000. Settlement rate is 10%. Actual return on plan assets is $10,000. Funding contributions $8,000. Benefits paid to retirees during the year are $7,000. So prepare the pension worksheet for 2017. So here, you're taking the information and filling out the worksheet. And so your service costs were $9,000. Your actual return was $10,000. Contributions were $8,000. Your interest costs were calculated $100,000 for your plan assets times 10%. So if in your general journal entry section, your journal entry is $9,000 for pension expense, $8,000 for cash, which leaves $1,000 liability. And here in the memo record, it's $100,000 for projected benefit obligations and $100,000 for plan assets, the $9,000 for service costs, $10,000 for interest costs, the $8,000 contribution, $10,000 for actual return, and the $7,000 for benefits paid. If you look back to the prior page, this is where the information is coming from. Once you've put the information into your worksheet, this is the completed worksheet, and then it follows your journal entries. Pension expense for $9,000, which is coming from here. Cash, $8,000 credit. And you have pension assets / liability for $1,000.